I'm Markus. I'm in charge of RippleX Growth. And yeah, super excited to host this crypto panel at UBRI Connect. As you may know, crypto has been the best performing asset class in the last 10 or 12 years or so. And even if you consider the latest crunch that has started this year. There's a fair argument out there that there's too much, like crypto's too much about speculation. It's too much about hot air and too little about real world application and utility. At the same time, this speculation has created a $1 trillion industry and empowered that industry with important resources to innovate. So what we want to do in the next 25, 30 minutes or so is take a scientific look at this crypto boom. And we'll do so through the lens of three experts in the field from around the world, Francesco, Roy, and Jefferson. So that should be a lot of fun. Gentlemen, it's great to have you here. Thank you so much for making yourselves available and sharing your views. Would love to give you an opportunity to quickly introduce yourself in a minute or so, talk about what research focus you cover on the blockchain side, and then we'll dive right into the questions. Jefferson,
okay.
You want to start?
Okay, so it's a pleasure to be here in this panel. I'm an assistant professor of finance in Brazil, in FGV. And my research is focused on the role of crypto assets on retail investors' portfolios. Okay, and I'm also interested in the behavior of investors. So this is kind of the two strands of the literature that I work on. And also I am the head of this partnership in the university. So I manage all the educational research and extracurricular activities that we do in FGV.
Roy?
Hello, everyone, and thank you very much for that excellent introduction, Markus. My name is Roy Chen-Zhang. I'm currently a PhD candidate and researcher in general finance at the University of North Carolina at Chapel Hill. In terms of my research interests, they mainly lie at the intersection between traditional finance academia and the emerging blockchain ecosystem. To put it more succinctly, is to use new data and new concepts to address old existing pertinent questions.
Thank you. Jeff.
Thank you, Markus. Thank you, Lauren, and everyone at Ripple for organizing this amazing event. My name is Francesco Pierangeli, and I'm an assistant professor of finance at the University of Birmingham here in the UK. I'm also a research associate with the UCL Center for Blockchain Technologies. I'm an economist, and my research focus is on how distributed ledger and blockchain can be integrated into socioeconomic process more broadly.
Thank you, guys. All right, let's get cracking. So first one, what are your main observations about the crypto asset market today, particularly if you compare it to, say, 5 years ago? And is there any evidence, sort of underlying force or trends that you think is changing or shaping the future landscape of it? Francesco, you can go ahead first.
Yeah, I think it's a great question too. Especially, it makes us all think about what happened 5 years ago, right? So I remember back then I was working for a large bank. I'm not gonna name it, but you can just look on your right. You may eventually see it. And at that time, I think it was September 2017, and that time, so exactly 5 years ago, the CEO of that company say that he would fire anyone who would trade Bitcoin. And that the entire thing was a scam. That was, of course, made headlines and stuff. That is, I guess, fast forward 5 years, we have major institutional investors such as Fidelity or BlackRock opening up their platforms to providing exposure for their clients to digital assets, which is something that I was really certainly not expecting to see in such a brief time. And also, most recently, even in the US, Colorado just announced that they're going to be accept Bitcoin as a payment for tax. And again, something that is just within the space of 5 years. And it makes sense if you think about it. 5 years ago, the market cap for the entire crypto market was not more than 30, 40 billion. That was before the bull market of 2017, 2018. And now, even after the peak at 3 trillion, we are still at $1 trillion. So we're talking about like 40x, 30x compared to 5 years ago. So I guess that is certainly the reason why would make sense with such a sizable market for institutional investors to actually be in and understand perhaps that this is not a scam.
Thank you, Francesco. Roy or Jefferson, anything you want to chime in with?
Sure. So I'll talk a little bit more, on the more intangible aspects. So I think really from the past 5 years until now, the whole crypto and blockchain and decentralized finance space has really moved from, being more on the margins of our culture, towards being really deeply engraved in the cultural zeitgeist of the last couple of years. So everyone from the barber at my local barber shop to us in professional, academia, to even some of the biggest asset managers and their heads of strategy are all considering about the future of cryptocurrency and on how to efficiently integrate and allocate cryptocurrencies and DeFi and other blockchain-related technologies into the mainstream of their business models. And I would say that this really signals an important turning point in the widespread adoption and eventual universalization of these technologies, much like previous technological revolutions. And it's interesting because not only have we seen a lot of growth, but we've also seen acceleration at the pace of the growth in the past few years.
Thank you, Roy.
Just would add that nowadays it's a lot easier to get exposure to crypto. So for retail investors, like in Brazil, we have more than 10 ETFs right now, so you can get exposure using the home broker, the same that you use to buy and sell stocks. And a lot of retail banks are entering the market and offering easy ways to invest. So for those people that are not tech savvy and they find that barrier something relevant, and because of that they didn't enter the market, now they can enter. So I think that's a big difference. And also the corporations that enter the market, like Tesla, MicroStrategy, Square, something like that, I think that it's another dimension of this corporate and institutional development in these few years.
Cool, thank you. Just quick follow on, based on your research, do you have any sense about sort of like a percentage ratio, how much is like institutional participation? Because that's kind of like the theme that you all guys conveyed versus retail. Is there anything you've seen or in terms of like the research you covered? Yeah,
I think at the end of the day, I mean, a lot of people can organize conferences and can talk about crypto, and certainly there was no shortage of that in the space. However, when you see what I mentioned before, when you see actually large asset manager opening up their platforms, that is where, and linking the two markets together, that is where you can clearly see that they are not just there's not just cheap talk, but they're actually doing it,
right?
And they're doing it for the long term.
Cool. All right. So some argue that the crypto boom in 2020, 2021 was largely fueled by sort of incentivization programs and kind of like artificially inflated exorbitant yields versus TradFi investing, right? And now, obviously, these 1 million% APY scenarios have certainly contracted since crypto winter has set in earlier this year. How attractive is yield farming today? How do you assess the sustainability of crypto yields more generally and specifically around DeFi?
All right, so I guess I'll take the lead on this one. Thank you, Marcus. So I actually have a co-authored paper with Donghua Xin and Patrick Augustin that looks specifically at the risk and return profiles of yield farming. And theoretically, to really motivate the presence of yield farming, there's two main channels by which yield farming plays into the broader economics of the ecosystem. The first issue is that, by and large, liquidity provision in automated market making is ineffective and unprofitable without any additional intervention. In fact, if you think about traditional market making, the market maker has the authority to decide whether or not to accept a trade and to adjust the terms of the trade as revealed by the willingness of the market participants to trade. However, as a provider in an automated market maker, you do not have the authority to refuse a trade, only the authority to migrate your liquidity in and out of a liquidity pool. Therefore, you're always being on the opposite side of traders that potentially have useful private information about the future price movements of an asset. And consequentially, when an asset goes up, you hold less of it. And when an asset goes down, you hold more of it. This can also be thought of as connecting directly to the presence of impermanent loss. And yield farming really helps to subsidize liquidity providers for this loss by providing them an additional source of income such that they're able to confidently stake their cryptocurrencies in these automated market liquidity pools. Now, a second issue is about competition between exchanges. If you think about one of the largest decentralized exchanges, Uniswap, they do not actually provide any yield farming. And this is because they hold right now a relatively dominant position amongst decentralized exchanges. And in terms of platform economics, it's actually strictly better off for all liquidity to be concentrated in a couple of large exchanges because you have a broader base of assets with which to trade against. You have, relatively speaking, larger pools, which means lower slippage on your individual trades. And therefore, there's sufficient incentives to try and compete very aggressively in order to overtake your competitors and become the dominant player in the field. And by offering yield farming, you can actually attract liquidity providers away from your competitors and towards your own platform, and thereby further this goal.
Thank you, Roy. Anything you guys, either of you want to add?
I will just quickly add on what Roy just said regarding exorbitant yield farming returns. So that was something that scared me a little bit because it's just posing a signaling mechanism problem for us. Because when you are offering huge returns, you are promising huge returns, then what happens is that you have people who are already skeptical will become even more so. And we can all agree with that because if you're already skeptical towards crypto and then you hear that if you just contribute to say $1,000 or £1,000 worth of crypto, then you can have a return of 100, 200, 300% within a very short time. It just doesn't look good. And then on the other hand, attracts a lot of speculators, which instead or opportunities or risk takers. So that's I guess it's one of the issues.
Got it. Jefferson?
No,
good. Covered?
Yeah,
Cool.
yeah, covered.
So now let's move on to sort of like, who's behind all this? Who are the market participants? And to kind of like simplify it further, how would you describe the typical sort of crypto market participant? What are your key insights in regards to sort of demographics, gender gaps more broadly, and regarding behavioral biases or sentiments that is based on your research and why? And separately intertwined, are there any sort of like key differences or similarities between TradFi and what do you observe in the crypto world?
Okay, I can take that one. There are two strands of research on that. One follows like very detailed administrative data from one exchange, for example, so you can follow all investors and what they are doing, how they are operating. So that's really interesting to check the behavior patterns. And the other one is using surveys. So there are two different methodological studies. But I would say that the studies that I know, and I think science could contribute for that, is that investors, they tend to be, before investing in crypto, they tend to be more likely to invest in other financially innovative products, like new ETF from some kind of biotech. And so even before, and there is a study on the Review of Finance that shows that very interestingly, is that crypto investors, even before investing in crypto, they're more likely to invest in these innovative products, okay? So in that sense, crypto is more an extension and something new for investors that they were before more prone. But after they invest, they change the behavior, okay? They are a lot more active than their peers that do not have crypto in their portfolios, okay? They're trading a lot more. Interestingly, they tend to invest in stocks with certain characteristics, like lottery-like stocks, penny stocks. They kind of follow a momentum strategy, so they tend to pick their money on stocks. They're doing great. So it's not like general diversification. They kind of diversify on very risk risky products with certain characteristics. So it's not the case that they are, like, I invest in crypto, so I reduce risk in my overall portfolio. No, they seem to, to complement with other riskier assets.
Does that innovative risk behavior also include things like poker stars, or?
Yeah, in that study particular, not. They didn't look, but could be. I mean, some kind of gambling utility function, something like that. And the other strand, and we have research on that on FGV, is that using survey, the crypto investor, and there is a lot of studies that point to the same direction. The crypto investor is male, okay? He's young, about 30 to 39 years old. He's a risk lover. He tends to be pessimist with the real economy, okay? So we understand crypto is kind of a hedge for these contingencies like inflation, low economic growth, and something like that. So I think, but not every crypto investor is the same. I can talk about this later, but there's some kind of heterogeneity in that.
Thank you, Jefferson. Roy, Francesco, anything you want to add?
Sure. So I'll talk a little bit about my own experiences looking at the demographics of crypto investors. So in my study of yield farming, for instance, we find that the median investment size out of approximately 600,000 market participants was, I think, 170 something US dollars. So therefore, these are not very large accounts, and these are not very large investments. And anecdotally, we will find that, relatively speaking, these investors aren't that sophisticated either. In the August 2020 survey by CoinGecko, it was reported that upwards of like 79% of users actually claimed that they were really well acquainted with the mechanisms underlying liquidity provision and yield farming. Yet, around 33% of them either reported that they could not actually read or understand smart contracts, or they report that they did not understand the concept of impermanent loss. Now, if you add those two together, you'll see that it's much more than 100%, which means that some people claim to be comfortable and fully understanding of the characteristics of their investment strategies without actually understanding them. And this is a phenomenon called overplacement, in which you overestimate your own capabilities when relative to your peers. And another interesting thing that we've been able to replicate in the equities research is this idea of under-diversification. A recent article by Tarun Ramadorai and co-authors found that in the Indian stock market, a very large proportion of accounts actually only hold one security and are very, very under-diversified. And in our own preliminary examinations on the Binance Smart Chain, we found that out of all the accounts that hold ERC20, which is meeting certain fungibility criteria tokens, approximately 40 to half of them at any given point are actually only holding a single token. And therefore, this is a little bit of a puzzle, both at the industry level and for academics, as to why this is, because conventional wisdom would suggest that by diversifying, you rid yourself of idiosyncratic risk, and therefore you're able to improve the risk and return profile of your portfolio. So we're not really sure how to approach this yet, and it's an open question.
Absolutely. No, just a final comment on that. There is also further segmentation of the market, I believe, when it comes to adopters. So if we look at the centralized versus decentralized setting, so the typical user for, say, the Binance or the Coinbase exchange is very different from the one that perhaps uses this DeFi. So there is a further sophistication in there. For sure, we have, what Jefferson mentioned regarding segmentation is absolutely correct. And it is even worse when you look at decentralized settings. Because in centralized settings, you can have like your uncle, or even your grandma, if your grandma is tech savvy now. But for sure, in the decentralized settings, when it comes to actually signing transactions and stuff, not many people can reach that level.
Thank you, guys. Let's touch quickly on sustainability. So in a world where ESG investments is continuously gaining steam, Bitcoin is kind of like, keeps swallowing larger and larger countries, and at the same time it's meant to represent an innovative, forward-looking asset class, right? So at the moment, I think it consumes the energy of the entire country of Argentina. And separately as well, we've seen with Ethereum's recent merge that, this network can ecologically evolve by the move into proof of stake and supposedly eradicating 99% of the CO2 footprint. But nothing really seems in sight for Bitcoin regarding this. How do you assess the situation, and do you see this Bitcoin problem being resolved in any way?
Yeah, I think I can.
Francesco, you can go
Add
first.
on that. So I believe there are three elements here. So first is the real environmental impact that the Bitcoin has, the one that you mentioned before. Then second is the perception of crypto users about it. And third is a certain ethos or ideology which is creating resistance to change, in particular in some crypto communities such as Bitcoin. So in a research I was involved, we focus on, we try to assess the electricity consumption awareness of crypto users. Because at the end of the day, the more people adopted certain cryptocurrencies over another as a trade-off, the higher is going to be the price, or the higher is going to be the notoriety of that crypto. So we conduct a survey in Nigeria, because Nigeria is a great example, can be used as a proxy for developing countries. There's very high level of adoptions, and there are also few issues with the local banking system, which relates to many developing countries. So what we found is that 70% of underestimated energy consumption of Bitcoin, and only 15%, 1/5, were able to accurately ascertain the energy consumption, the effective energy consumption. But what was interesting, though, is that all the participants, they self-reportedly being experts in cryptocurrency, as defined as the amount of transaction they conducted with Bitcoin. And interestingly, out of the 15% that's accurately assessed the energy consumption of Bitcoin, the vast majority, almost 90%, would agree on measure target towards addressing issues that are related with environmental issues for Bitcoin. So basically meaning that the more accurately can you estimate the electricity consumption, the more you are aware, the more in favor of this measure you can be. And what we proposed was a simple energy labeling mechanism where you basically give that as a signal to a point of exchange. So you just next to the crypto, you just place something that is indicating whether or not that crypto is sustainable or not sustainable. And although this, of course, can only be applied or enforced in a centralized setting, because no one can impose that on decentralized platforms, we also found out that 80% of these people, they traded cryptocurrencies on centralized exchanges, mostly. So that can still help nudging their behavior towards more sustainable options, and perhaps even contribute to this, the transition of Bitcoin, of proof of work cryptocurrencies, towards more green mining process.
Thank you, Francesco, for sharing all these insights. Anything either of you wants to add?
Sure. So I mean, I look at this in a little bit more of an analytical way. So what's the problem? The problem is electricity consumption is high. Why is electricity consumption high? Difficulty is high. Why is difficulty high? It's because there's too many miners competing to mint the same amount of blocks within a certain time horizon, right? So in order to actually address this problem at its root, we need to think about what parameters we can change regarding this, block to time limit. So obviously, the amount of blocks being set within a certain time interval is fixed and immutable. But in terms of the timekeeping conventions, there's actually a little bit of flexibility around that. And this is something that I haven't heard anybody really address here. But the idea is that timekeeping on the Bitcoin blockchain is not exactly congruent to actual timekeeping in the real world. And in fact, regularly speaking, the timestamps of newly minted blocks can be up to 90 minutes away from the actual time in the physical world. So one way to maybe think about this is to consider perhaps a way of accelerating the timekeeping that we're using on blockchain. This will, in fact, effectively increase the amount of blocks that can be minted per unit of physical time, and thereby reduce the difficulty. And this is incentive compatible for miners themselves, because they're able to produce more blocks and therefore get more rewards within the same amount of time and consuming approximately the same amount of energy. Now, of course, there are some limitations with the source code of the Bitcoin blockchain that prevent a dramatic increase of the timekeeping conventions. But even right now, every 2 weeks you can speed up time by 2 hours, so 0.6%. If you compound this over a year, that means you can speed up time by upwards of 15, 16%. And if we proceed this into the long run, this means that difficulty will go down with processing transactions. And the longer run effect of this is that this will increase the rate at which Bitcoin halves, and therefore depreciates the utility for miners to continue participating in mining blocks on Bitcoin. And thereby, they'll be less willing to provide additional energy and resources towards verification of new blocks. And therefore, if we start now and commit to this acceleration, in the long run, we can actually address this problem and thereby create a more efficient Bitcoin blockchain network.
Thank you, Roy. Very interesting points. A quick one.
Quick one,
Yeah.
very quick one. We're doing this research, this survey with Brazilian investors, digital investors in Brazil, partnering with several investment offices, the largest one in the country. We intend to do it yearly to address topics like that. So this kind of, like if the environmental dimension enters the utility function of investors, it's something that we would like to address in the next one.
Thanks for sharing. Cool. So one of the key promises, if not the key promise of this whole technology, is that through this concept of decentralization, disintermediation, everything will become more efficient, society will become more productive and prosperous. Do you guys think, and through the lens of finance, do you guys think decentralization is really the holy grail sort of end state and solution to everything around financial markets? And to what extent may centralization be helpful in concepts like finance on the blockchain? How do you see this play out?
Sure, so I'll just talk very briefly about this. So in terms of traditional economics literature, if you think about papers like Diamond and Dybvig or Diamond 1986, called Liquidity, Banks, and Markets. The idea of these papers is that the role of the intermediary is to facilitate risk sharing between individuals that otherwise cannot coordinate effectively. Now, of course, decentralized finance provides an automated solution to this in that individuals now can actually share risk in an entirely open and transparent manner. However, outside of the distribution of risk, there are also other reasons for which an intermediary might be present. One is economies of scale in transactions. Every time you send a transaction on any blockchain, you need to pay a gas fee and perhaps even a fixed transaction fee when interacting with a specific platform. An intermediary can bundle transactions from a bunch of different individuals and thereby achieve economies of scale and reduce the per transaction cost for everybody involved. A second way to look at this is to consider the difficulty with which it is to evaluate some investment products. And to bypass this difficulty, you could use delegation and delegate the management of your investment into an automated strategy, such as a vault, for instance, on blockchain, which bypasses some of this complexity for you, and everybody wins in the end.
Thank you, Roy. Anything you guys want to add?
I just very briefly that the scalability trilemma, the one where you have the centralization, scalability, and the security, it's a great topic for future research. There is a lot of potential in it.
Yeah, couldn't agree more. Jefferson?
I would add that for the future bull market, something that we discovered is that there are a large heterogeneity among investors, crypto investors. For example, young investors tend to be more likely to invest because of the popularity or the historic of growth, so backward-looking measures instead of forward-looking measures. Sophisticated investors, on the contrary, they're more likely to invest because of macroeconomic and portfolio factors. So I think it's more like a calculated form to invest, like a portfolio, a small allocation that could, protect you in contingencies, protect your tail risk, something like that. So that's important for the investor. And I think education in overall, in blockchain and what we're doing here,
cool.
In all UBRI, it would be interesting, to kind of change the mindset of some user that see some YouTuber, and they think that they will win money.
Excellent.
That's not like that.
Okay, 5 to 10 seconds each. Fire up your Coinbase apps. What's your prediction for Bitcoin end of 2025 and why?
I have no clue on that. I have no crystal ball, but I think the next boom market will be more sound because people learn from their mistakes. So I'm kind of optimistic on that.
Roy?
Well, I mean, this is really your expectation of other people's expectations, because that's going to be the realizable price. So, I mean, what I would do is I would maybe do if we had more time, do a show of hands of everybody in the room, see what their expectation is, take the average of that, and then discount that by 5%.
That's awesome.
Exactly.
Can we have a number finally, Francesco?
Don't worry, I'm here to save the day. Yes. So, I don't see the pen. No. So what happened is that, I mean, large financial institutions, despite the fact that they call it a scam back in the days, they are forecasting 6 digits price number, and which I believe could be one of it. But unfortunately for all of us, large financial institutions, when they forecast future prices, they are often wrong. So I will still give you the above.
So 6 digits, 999,000 it is then.
Yes.
Pretty good.
So thank you very much, gentlemen. By the way, we'll host the crypto-themed lunch on the 50th floor at 12 o'clock. Francesco and I will be there, so we're going to take questions there. And thanks everyone for listening.
Thank you, Mark.
Thank you very much.
And if you guys feel free to reach out to us on LinkedIn and as well. I'm sorry, but I personally can't be at the lunch because I have another conference in Montreal I need to run to.
Yeah.
But I'd love to connect.
Conference topic. Thanks, Roy.
Academic conference, don't worry.